What is going on, investors? Hopefully guys are doing well out there, and how could you not be doing good? First of all, it's Friday, the weekend is here, but more importantly than that, it's time for the FAANG Stock Recap Show here on the Investor Channel, where every Friday we recap all the major news of the week and the technical chart patterns from all the major FAANG stocks. And we come to you on a week where the vast majority of these companies reported their earnings, including the first company we always talk about, Meta Platforms. This stock started the week closer to $169 per share, ended the week closer to $159 per share. This is on the heels of getting our Q2 earnings over at Meta, which revenues came in at $28.82 billion, or a decline of about 1% year over year. It did miss expectations by about $130 million, and our EPS also missed estimates as well over at Meta. But I don't think that's what investors really care about in the current moment, because we saw Microsoft put up a miss on the top and bottom line, and that stock is ripping to highs. What likely is sending Meta down, among a number of problems over at the company, is their guidance came well underneath Q3 estimates, and that's the name of the game right now. There's uncertainty in these markets. There's certainly uncertainty in the economy, and so we're looking for confirmation of what the future might look like. And when companies like Meta come well underneath those expectations, you can also look at an Intel and a Roku. A lot of stocks falling when their future predictions look a little murky, and that's probably the biggest change since Meta reported their earnings on July 27th. I'll put links in the description down below and the first pinned comment if you want to view all our earnings videos from all these companies except for NVIDIA, which will report their earnings in August. So we're not going to cover a lot of the minutia of the financials. I already have links to those. There's timestamps as well if you want to jump around to different parts of the video. The thing that has changed though since the July 27th earnings over at Meta, despite the stock continuing to decline, is we saw that the Q3 estimates, this is again predictions and forward estimates over at Meta, continue to be reined in. And I don't think this is the last of these revisions. We'll certainly keep you abreast every Friday on these. If they continue to change, I'll update them, because the initial Q3 revenue estimate over at Meta was closer to $30.5 billion, or about 5% revenue growth. Now, the revised estimate comes after Facebook gave guidance on their Q2 earnings report of about $26 to $28 billion worth of revenue. So now the Wall Street is kind of towards the top end of that estimate, estimating Meta's revenue will be $28.5 billion in the upcoming quarter. That would actually represent a second consecutive quarter of declining revenue to the tune of about 3.2%. Again, that's if Meta is able to come in towards the high end of their guidance. Now, obviously, you start walking back your Q4 and your Q1 into next year's estimates over at Meta as well. Q4 initial estimate for Meta was $36.6 billion. Now it's $33.24 billion. In Q1, analysts were projecting $31.4 billion in revenue. Now you're looking at just 29.2. So analysts' expectations for Facebook is that this company will have 3 consecutive quarters of declining revenue growth, and that we won't see an acceleration until Q1. And certainly if you ask different investors, they'll have a lot of opinions on where or what Meta's revenues will be in Q1. We have to factor this in when we talk about this valuation at the current moment. And again, I think earnings estimates are going to continue to come in on Meta, not go up. And so right now, at this very moment, Meta's trading at about 16.6 forward PE. Certainly from a comparison basis to where Meta has been in the past, the PE ratio is rather small, but we have to factor in that Google's price to earnings ratio is just 3 points higher at about 19 forward as Meta. So this stock is still, in my opinion, not cheap enough to just ignore everything else that's going on over at Meta. It's simply not cheap enough yet. Now, some other things happened this week over at Meta. The FTC is overruling its staff, which suggested that Meta should not be sued for a $400 million startup acquisition of a virtual reality app maker that makes fitness apps. Facebook decided to buy this app maker, integrate it into its Oculus, and the staff of the FTC was probably like, guys, this is a $400 billion company. It doesn't have a dominant position yet in AR/VR. We probably probably can't block this $400 million acquisition, but the head of the FTC has something growing up her you-know-what, because she overruled her staff and said, no, we will take this to court, where, in my opinion, I'm not a lawyer, but they have absolutely no chance of enforcing something like that. Maybe Meta comes to the table with some kind of concessions, but I doubt they even need to do that. Now, Instagram backed off some features that they were testing amid some user backlash, including notable posters Kylie Jenner and Kim Kardashian. This included features that would like pop a full screen video without you really even doing things on Instagram. It would also push you more suggested content, similar to like how it is here on YouTube. Some of you might be watching this video and not be subscribed to the investor channel. And how could you possibly do that and not hit the like button? But also TikTok as well. So TikTok suggests a lot of content to you, whereas Instagram tends to only show you content from people you've interacted with or are personally following. And this grew backlash, and Instagram decided to roll some things back. But I personally think Instagram is in the right here. They need to continue to innovate that platform. Every single time Instagram or Facebook has tested a new feature that ended up being popular, people backlashed against it at the beginning. I would trust Instagram more than I would the users, quite frankly. Now, Meta Platforms is cutting funds for news partners. This relates to a news story that we talked about last week, that Meta was paying up to 50 publishers to like post their news on Facebook, which really seemed odd to me, because Facebook is where the users are. This is where any publisher will just gravitate to naturally. And in fact, they probably will buy ads and pay you to get in front of that audience. I don't know why Facebook was paying them. They stopped that stupid decision after they looked into user data, realizing the vast majority of people that go to Facebook, newsflash, don't look to read the news. Mark Zuckerberg says Apple and Meta are in a deep philosophical competition over the metaverse. Clearly, Mark is completely bent out of shape. Apple has done a number of things to Meta over the years that just has made that business over at Meta more complicated and more difficult. More recently, the Apple iOS 14 changes back in 2021. As we've seen, this company's revenue growth has basically fallen negative since then. And I'm sure Mark is just absolutely burning over that. And he is now, in my opinion, getting into a battle he has zero chances of winning. Facebook, otherwise known as Meta, has never shipped a hardware product that any large number of people want to buy in mass. We're talking about tens of billions of dollars. Some of you are probably strapping that Oculus to your face, but you are in the minority of people out there. While I respect Mark's tenacity and his determination, I think he should focus on Facebook's core business and worry less about Apple, which has way more money and way more expertise when it comes to making devices. Now, Meta is boosting the price of their Quest VR headsets by $100, citing rising costs. This is certainly not going to help demand and certainly not going to help intake of these products. Believe me, the average consumer is very aware they can buy a headset and strap it to their face. This is not the next iPhone. When the iPhone came out, millions of people around the world lined up for that phone. And keep in mind, it basically like quadrupled your cell phone bill if you bought this. So you're not only signing up to buy one of the most expensive phones ever made, you're also signing up for the most expensive data plan AT&T ever offered. And people did that to the tunes of millions and now billions of devices. Meta does not have a winner. They have a niche product here. Raising the cost is not going to help that if they're trying to get mass adoption in that. Moving on to Apple, start of the week closer to $154 per share. Like some stocks that reported earnings this week, up huge to $162 per share. I mean, a 5% move, maybe not necessarily that huge, but we're talking about a $2.5 trillion company moving 5% in a week. That's a lot of money. Now, revenue came in the third quarter for Apple at $82.96 billion. This was essentially in line with estimates and just 2% growth. Shares reacted in a positive manner to iPhone strength, and you also saw strength in services as well. Apple also said on their conference call that they expect revenue to accelerate following strong quarterly results. They obviously head into a new product cycle as well. The CFO reaffirmed margins expected to be 41 to 42.5% in the upcoming quarter. Things looking decent enough for Apple to hold the levels that it was at. Now, Apple signed a Lamborghini executive to accelerate its EV efforts. This is on the heels of hiring executives from Tesla and other EV makers out there. It appears that this gentleman used to be the former head of chassis and vehicle dynamic at Lamborghini. We noted on our Apple earnings video, this company spent over $1 billion more in this quarter compared to last year on R&D. They're currently accelerating some kind of R&D over at Apple, and certainly signing executives like this would lead that maybe that the car is on the way. What would that do to Apple sales if they're able to put out something like that? Now, Apple suppliers and others are asked to operate in a quote-unquote closed loop in China to battle the virus. This is where if you work at Foxconn or any of these factories that are doing a lot of manufacturing, Tesla included, you're in a quote closed loop, which means you go to work and then you sleep somewhere on the facility and you don't interact with anyone except for the people that are there making those items. Personally, sounds like a really, really miserable time, but look, everybody's got to do what they got to do. And if we look at Tesla's quarter that they had making cars in the month of June, we factor in that Apple's coming on a big product cycle as well. This closed loop, look, from a social perspective, probably not ideal, absolutely not ideal, but from an investor standpoint, look, you got to get the job done, and it looks like that's the way it's going to go. Now, moving on to Amazon, start of the week closer to $122 per share, and to the dismay of many people in my comments, this one went up to $135 per share, but while you guys were dismayed, my IRA account looked great today. Revenue for Amazon came in at about $121.2 billion. That was 7% growth year over year. That actually beat expectations by about $2 billion. The bar for Amazon got lowered really a lot over the last quarter, as you had Target kind of bring in estimates. You also had Walmart last week bring in estimates as well. A lot of people pulled that in on Amazon, but if you watched my Amazon earnings video, probably more importantly, my preview video, this is a company that basically sells e-commerce stuff at a loss. They don't make money selling stuff on Amazon.com, but they make money on the ads. They make money on the marketplace sellers. They make money on the AWS business. They're going to make money on that content. They obviously make money on that Prime subscription as well. So when retailers like Walmart and Target pull in estimates, it might not, at least we saw in this quarter, apply directly to Amazon. Now, I don't necessarily think these Q2 results, which again came in over estimates, at least on the earnings side, that is not what's driving the stock. It was that forward guidance over at Amazon, expected to come between $125 and $130 billion worth of revenue. Consensus estimate was basically on the low end, close to $126 billion. That is a 13 to 17% growth rate. Again, when you have other retailers out there, your main competition over at Walmart, really pulling back their estimates to come out and say we're going to grow 13 to 17% and we beat expectations by $2 billion. Yeah, that's going to send your stock up over 10% during the trade today. And Amazon noted on their conference call that they actually see inflation, not inventory, as their key issues. And when Walmart issued that warning, and certainly when they talked about inflation on their last quarterly conference call, I went through it and listened to what kind of the CFO and the CEO said. A lot of the inflation and quote inventory problem that Target and Walmart especially are showing is actually in the food category. You've had such rapid food inflation, and those are the items like going in and out of the store constantly. And so Walmart's finding that every week that goes by, they're paying more and more and more. And so that's going to drive up the value of their inventory. Whereas Amazon, while they have exposure to grocery through Whole Foods, I would argue that the customer to Whole Foods might not be as price sensitive to inflation, since they already shop at a grocery store that's perceived at least to be more expensive. But the vast majority of Amazon's carried inventory in their warehouses is going to be physical goods. And I think we're seeing less pressure on price increases, especially if you bought these goods 6-12 months ago and you're kind of warehousing warehousing them or you're just getting them now, inflation less of a toll rather than inventory you're constantly having to rebuy on a weekly basis. Now, some of you might think I'm this, massive conservative over here. I'm always kind of talking trash on liberal politicians looking to regulate. No, I'm an equal opportunist when it comes to trashing these politicians that have just done a terrible job. We're not just talking about over the last couple of years. We're talking about decades of mismanagement has led this country to where it's at, including Senator Josh Hawley, which is a Republican from Missouri. He says that he is urging the FTC, which again is suing to block a $400 million deal from Meta to a quote startup, unprofitable startup AR app maker. You better believe the FTC will definitely be looking at the One Medical acquisition that we talked about last week. That was a $3.9 billion deal. And on paper, Amazon was paying like 3 or 4 times sales for this. And look, the stock went up today 10%. That'll give them plenty of money to buy this kind of company. So I have no problem with the FTC kind of maybe taking some issues with this, doing a little bit of investigation. But here's the senator's reasoning. He says this particular acquisition, if allowed to proceed, would represent an alarming new direction for Amazon that already wields far too much power. So I didn't know here in the United States that if you weren't in a market that you couldn't go expand into a new one. That's a head scratcher for me. And finally, the senator adds a market might be competitive now, but in a few years, Amazon gets involved, it won't be. So now the FTC is being issued guidance to stop companies from potentially creating a monopoly. That is also news to me, and I'd love to get that in front of a judge because I don't think they would believe that either. Also, the thing that we have to remember is Amazon, again, sells things at a negative margin. This is a company that doesn't generate an operating profit from selling their goods. How is that inflationary, Senator? It's just unbelievable to me. And the minute you start looking at all these politicians the same, doesn't matter which side they're on, trust me, you'll become a better investor. Now, the FTC said to be unlikely to be able to challenge Amazon's planned One Medical purchase. Again, a lot of this will be played out in the court to get this in the right judge. These should end up in the favor of Amazon and that aforementioned deal with Meta. Now, the WWE jumped 8% as Loop Capital suggests that there is a greater likelihood of this company and its properties to be sold. Now, I looked at the WWE. It was interesting. It's just like a $3 or $4 billion deal, which doesn't seem like a lot of money, especially when you factor in what some of these streaming platforms are paying for content and certainly sports rights. The whole WWE worth like $3 or $4 billion without a premium seems interesting. Vince McMahon, who obviously is the CEO and chair, I think the former now CEO of the WWE, he's left in kind of a disgraceful fashion, but it kind of fits the WWE mold. Vince McMahon, it complicates the situation a little bit because Vince McMahon is essentially a character, I believe, on the WWE as well, essentially playing himself. And so it'd be complicated if the company sells. Could you still retain the performance rights of Vince McMahon? That would be interesting. Analysts are projecting that if it's sold, you could have Netflix, you could have Disney, you could have Amazon, you could have Comcast, you could have a number of different likely buyers of the WWE if they decide to sell. Moving on to Netflix, start of the week at 221, holding that level up there at about 224. We'll talk about that from a technical perspective. Not a lot of individual news around Netflix, which reported their earnings last week, but we did get earnings from Roku, and that stock slid over 22% as their Q2 miss and their outlook and their guidance was really, really bad. Now, what we're talking about with Roku is the fact that there's been rumors that Roku might combo up with Netflix, and certainly now as this stock continues to slide down, the potential of something like that could materialize. Obviously, we've got to worry about the FTC likely wanting to block that deal as well. Moving on to NVIDIA, start of the week closer to $168 per share. Oh my God, this isn't Intel, this is NVIDIA, and it's up 8% this week to $181 per share. This is on the heels of lawmakers surprising the heck out of me and actually doing their job and passing a bill called the CHIPS Act, which was on a bipartisan basis. I think this has been sent to the president. He may have signed it already, I'm not sure, but this includes about $52 billion in subsidies. You also got another $24 billion in tax credits, but the real kicker in here is you have $200 billion over the next 10 years to boost scientific research. Gotta love those handouts in those bills. In the long run, probably beneficial, at least from a tax perspective and an investment perspective in the chip industry. But we'll see if anybody's ever going to be able to profitably break ground on something like this here in the United States. I remain skeptical about that. Now, chip stocks end the week mixed as Intel hit a 52-week low after below standard is being a compliment. Intel, if you watch my video, was just an abomination on not only the current quarter, but the subsequent 2 quarters as well. They saw revenues, margins, inventories tick up. Everything was a disaster across the board with Intel. AMD moving up higher as they report earnings very soon. NVIDIA also going higher. The chip industry, at least from an investor perspective, believes Intel going down, bullish for the other stocks out there. Moving on to Google, started the week at 108, ended the week closer to 116, just slowly churning up on this one. This is after reporting their earnings as well on July 26. Revenue came in at almost $70 billion, but a lucky number, $69.69 billion. That was 12% growth year over year. They also missed expectations by about $110 million. They missed on that EPS side. I get comments a lot on the channel talking about, well, this company missed and this company missed, and why did they go up and this one goes down? Folks, you can't just look at the headlines and determine which way or the reasons why a stock goes up. Some of the reasons why Google continues to trend up is they have a control over their ecosystem that the Meta platform simply does not. They control a browser, they control an operating system, they also control a search engine, which is the default search engine on the Apple iPhone. So, and they pay billions of dollars for that, right? Apple's certainly not going to turn the spigot off on Google like they would on Facebook. Across the board, you saw relative strength. You saw some weakness here in YouTube. You'd like to see that reaccelerate, but you saw strong growth in Google Cloud, and that's certainly bullish for Google in the long run. On the earnings call, they did say over at Google, hey guys, we got some tough comps ahead. That's basically my interpretation of it, is that they don't think they're going to grow more than probably single digits for the foreseeable future. I'm talking about the next couple of quarters over at Alphabet, but it's not necessarily something to be alarmed up. Again, I talked about how the forward multiple on Google is barely 3 times more than Meta. So you have to factor that in when you talk about Meta's valuation. It's not far from Google's. And management over at Google, while a little bit tepid on the guidance, weren't really that as bad as Meta. And also, they're not really pulling back on CapEx spend, where we're seeing Meta kind of pull back on all kinds of things. Now, ad tech's jump on the report that Google is delaying their end to third-party cookies. Again, this is on the Chrome browser. They were supposed to end it, I believe, this year, and then they moved it to, now it's to 2023. Now I think it's going to be 2024. Google, unlike Apple, has no reason to have a really blunt hammer when it comes to these, quote, privacy things, when it comes to cookies and tracking your web history. Google will be slower to roll these things out, make sure the technology is there so their partners don't get obliterated, quite frankly, like Facebook and many advertisers were last year when Apple rolled out those privacy changes. Now, Microsoft looks to Google and others to help curb Amazon's cloud computing prowess. According to Microsoft and other reports, the United States government loves AWS and continues to go to them. So Microsoft went to Google and Oracle to try to form kind of a union, so to speak, and maybe get more of those government contracts passed down to them. Now, moving on to Microsoft, started the week closer to $259 per share. Boom, all the way up 8% to $280 per share. That's after reporting their Q4 earnings just a couple of days ago when revenue came in at $51.9 billion. That was good for 12.4% year-over-year growth. They did miss expectations, just like Google, just like Meta. This stock missed expectations from that revenue side, missed expectations on that earnings side. And some of you are like, why did it go up 8-9%? Folks, we are in an uncertain time. So companies that can give us some certainty about the future, people are going to go to that before they go to the speculative stuff like Meta. So Microsoft rose as analysts praised the, quote, bullish guidance heard around the world. A little bit of hyperbole there, but I get what the analysts are trying to say. Now, Satya Nadella got on the call and he said that Microsoft will invest to take share. I love that, and build amid economic certainty. Now, what else are you seeing over at Meta? They're not giving us any confidence about the future. Intel, Roku, we could just go down the line with a number of different stocks that are giving us uncertain guidance on the future. Not only that, a lot of those companies are also starting to rein in costs, cut employees, cut major expenses, raise prices on certain products. I love the Microsoft strategy. When the tough get going, the mega cap go and capture market share and build. That's what Microsoft is doing. That's why you continue to hold this stock, and any kind of significant pullback, you continue to buy. Now, I do want to give some credit here. You know, we criticize lawmakers, we criticize ourselves, we criticize other investors, we criticize executives at virtually all of these companies, but I do want to give credit where credit is due. Amy Hood is the executive president over at Microsoft. She is also, more importantly, the chief financial officer. And when we were going through Microsoft's earnings, again, I'll have links to these all in the description below. I was going through cash flow over at Microsoft, and for the year, this is for the end of the year, the company had $89 billion worth of positive cash flow from the business. They spent $58 billion on financing activities, and they spent $30 billion on investing activities. If you take $30 billion and plus this 58, you get to a number so close to $89 billion that you burn through just $293 million off of $89 billion worth of positive cash flow. This is exactly what you want to see your investments do right now. Is you want these companies in an inflationary environment, also in an environment where competition is starting to feel the heat. You want to take every last dollar you get from operations and balance it out with different financing and investing activities over at the company. This is so incredibly hard. I try to do this on a month-to-month basis here for my family in an inflationary environment. Cash in your bank account, not that great. I have trouble doing it on tens of thousands of dollars. She did it near perfectly on $89 billion. As long as she's with the company, I would be confident about their financial situation. Now, moving on to Tesla, started the week at $807. Boom, 10% rise up to $891 per share. When you want beta in your portfolio, the Teslas, the NVIDIAs will deliver. Now, Elon Musk delivered some tweets over the weekend where he said inflation may be easing. He said that inflation may be, quote, trending down, but he's strictly referring to commodity prices as it relates to Tesla. He says more Tesla commodity prices are trending down, and he added for what it's worth, because I think he's saying here that the vast majority of inflation that most people are experiencing, and the one that impacts the rates that we're seeing, is energy prices. Commodity prices continue to trend down. This is bullish in the longer term if they can get some contracts now, lock these prices in, or they continue to trend down over at Tesla, should increase margins, especially if they can keep the prices of the vehicles high. Moving over to the technical segment of the show, we'll start things off with the S&P 500 breakout alert. Look at over the last, I would say, about 60 days or so, the stock market has gotten in a very steep uptrend. So if you're sitting on cash, don't worry. These type of steep uptrends, we've obviously seen them on this downward trend we've barely been in since the beginning of the year. These uptrends will tend to lead to some pullbacks, at least to a certain degree. Now, these uptrends are a little bit different later in this downward cycle. So I'm going to call it right now. When we see the pullback, we should see one pretty soon, I would guess, to retest this trend line here. There's also an upper trend line, which some technical traders would say we still need to get above this trend line to really cancel some things out. But we basically got back to the clusters of highs we made back here in June, right about 4130 on the S&P 500. We're either going to continue I think we're going to find out really early this week. We're going to either continue to bust up here. I think you could retest 42, maybe as high as 4,300 if this momentum stays intact. I think more likely you meet some areas of resistance and you want to come back and retest these areas down here, right about 4,000. If you break through there, understand that you still have a secondary uptrend that should have some support. This is probably where I am going to be a little bit more aggressive. Again, yes, we've had multiple pullbacks in this market, but when it starts to happen later in the cycle, that's when I get a little more excited that that could be closer to a quote unquote bottom. Now, moving over to Meta, they obviously reported their earnings earlier in the week. They reacted negatively to that. Now, from a very shorter term perspective, we were creating higher sets of lows, higher sets of highs. After the earnings, though, we kind of dropped out to the bottom of this channel. So this one's not quite intact anymore over at Meta. I would say still the dominant trend over at Meta is still this intermediate term that we've been in since the major drop after the first quarter earnings report. I think we retest this area down here at Meta. It's basically holding the 52-week lows or very close to them right here about 155, 160. Further move down, in my opinion, you retest the bottom of this channel. It would take you south of 150, probably more specifically about 145 on Meta. I think that can be a buy-in opportunity for a short-term trade, as there's still plenty of investors that look at the cash flow, that look at the cash on hand, and also look at the market opportunity that Meta has. I know I've spent a lot of time talking about the negatives. At some point, there are some positives there. Eventually, the market pays more attention to that. I think there's some short-term bounces. I am not recommending buying this, and I will not personally buy this as a long position. If I buy it as a trade, I set a stop loss very short underneath that area where I buy it, and I play the run up and I trailing stop out of this. That's how I'm playing Meta for the foreseeable future. Moving on to Apple, it got all the way to the top of the range. Now, I cheated a little bit because this was our range before I did this video, and when we talked about this last week, when I set up these channels, I'm trying to first of all cut through as many as the peaks as I can, but I'm also trying to ignore maybe some market euphoria either on the downside, or you could probably push this one up a little bit and to the downside. That's why when we peak up here above this trend over at Apple, while it's fantastic in the shorter term, and you can see this stock has gone absolutely parabolic. Back in the middle of June, this was down here at 130. It's bolted on over $30 per share. We're now up here at about 162. If the momentum stays in this one, we are probably almost 100% of the time retesting these highs, $20 higher at 182. The odds of that happening, I think, are somewhat low. I think we get pullbacks with all of these stocks, including Apple, at least to retest this trend line. You slice back through that. It brings more higher probability that you retest closer to the bottom of this channel, which I think will be here right about $140, $137 per share. That's where I would be a buyer of Apple. Moving on to Amazon. This one has broken out to the upside, but I wouldn't get super excited. And I also would not have FOMO if you wanted to be in Amazon and you were being cautious at these levels. I think that's a prudent thing to do as an investor. Well, I wouldn't get too worried because they're right where the stock's at. In fact, it like hit its head right on a kind of a perfect area of resistance. There's an area right here at 136 where the stock basically topped out today. If it keeps its momentum heading into next week, you could get up in here to like the 140s, 150s on this stock, but you should see heavier selling if that happens. You get pullbacks on Amazon based on the guidance that we got from them. Also, the pressure that their competitors are under. Okay, Walmart's having pressure. Target is going to see pressure. They have different challenges and different levers that they can pull than Amazon. Amazon obviously has its AWS business, and they have the leeway with investors to not make money on that e-commerce business. So this company can continue to push those negative margins while Walmart and Target might not have that luxury with investors. And so I think you're buying the pullbacks on Amazon as well. I would anticipate a pullback at least to the 120 area on this one. I would be more aggressive south of about 115 on Amazon. Now, moving on to Netflix, this gives us hope a little bit if you're hoping that your stock portfolio just continues to stay up. Now, I'm personally hoping for continued pullbacks. I think they materialize in the, not necessarily next week and maybe not even next month, but over the next couple of months, I think you get some meaningful pullbacks in stocks. Netflix showing maybe we're starting to top out here at a pretty logical space. I tell you what, Netflix could continue to go higher, but there should be some significant resistance up here at about 230, 240 on this one. You get a pullback in Netflix. You have an uptrend starting here. You have higher lows here. You also have a series of higher highs. I think we're in the midst of kind of an overshoot by the bulls. I think this stock pulls back at some point. You get a pullback in Netflix and and you like Netflix, you want to invest in this company, I think your shot is probably south of about 195 on that one. Moving on to the NVIDIA. Now, this company is the one company out of all of these that has not produced their earnings. It has busted out above the lows that it made, again, like most of these stocks, just a couple of weeks ago. Now, we're still in a secondary downward channel. We were in a very, very steep downtrend. This is this red line. I think I'm going to take that one out. I think it's too obvious that that one has obviously materialized and kind of run its course. I think we're now in this secondary downward channel with NVIDIA. We're making highs back here in May, a higher group in June. And if my theory plays out, we should have some highs here in July and August, and some red candles should materialize. I think could send you back to 160 on this one. If it retests the lows, you should get an opportunity down at 140. My guess is that would probably coincide pretty close to NVIDIA's earnings announcement, which is expected on August 24th. So we still got a long, long ways away. But based on the guidance that we saw from Intel, Qualcomm, and others, that all could pull NVIDIA down. Now, on the bullish side, you want a continuation of this rally. You have a continuation of this rally. $200 plus is in the cards for NVIDIA. Now, moving on to Google, a much, much tighter area of uptrend with Google. In my opinion, this stock is a buy if and when it pulls back to this upper trend line that we're starting to make. We're making higher sets of lows, quite frankly, since May, like clockwork. Now, it is not really reinforcing that with higher highs, but they are very subtle. Wouldn't surprise me if heading into next week, you get a continuation rally on Google, sending this one maybe north of $120 per share, but I think you should have some red candles show up, pull us back to this upper trend line. That can be your buying opportunity. Based on the weakness we're seeing out of Meta and others, I think I like Google. Now, moving on to Microsoft, this one has really broken out. As you know, when it comes to Microsoft, I've got a couple of trend lines here. I've got our bottom line down here. This is where we're probably, the reason why I have this in green, this is where you buy. When we get down to these green lines, those of you that are wondering about the coloring that I use, the green line is where you buy. The red line is where you start to think about selling this stock, especially if you bought it at green and you're doing it on a shorter term perspective. I don't get greedy and wait till we come all the way to the top of the range. I start selling at the middle of the range. Some of you might wonder, why is the top line green? And it is exactly why, because Microsoft did this week. Typically, you're taking profits at this point, but there's a secondary thing you could do at this point, and that is play the breakout over at Microsoft. When you break out from these upper trends, they tend to go on rather large rallies. We've seen that across the board this week, including with Amazon. Now, similar to Apple, there is a higher level that I have a thin red line here. If you are a shorter term investor, or you're close to retirement, or you need your Microsoft money next month for a down payment on a house, this is absolutely where you decide to sell this. There should be some areas of resistance right where we're at with Microsoft, but based on the guidance and the strength of the company's CFO managing the finances in this environment, you should get some kind of pullback. I think easily back to 260 on this one. More specifically, down here south of 250 would be, I wouldn't say a back the truck up moment, but would be a very, very nice moment. Now, speaking of momentum, when we talk about this breakout, Tesla had higher lows all along the way. They were not confirming that with higher highs. We talked about a number of different times here on the channel. This one was going to break hard, and it was probably going to break hard one way or another. I'm not Miss Cleo. I didn't know which way. It decided to go to the upside. And the good news for anybody holding Tesla stock is this one still has a long ways to go before it really exhausts this uptrend. This uptrend could continue up north of $1,000 per share. This is if you're a shorter term position in Tesla or you want to take some profits. I think you put on some kind of trailing stop heading into next week, because what do we know about Tesla and really almost all stocks is when they go on these massive steep rallies. I mean, this stock constantly goes on these big steep rallies. What typically follows it? Some big gigantic red candles, and those are tough to buy because the news flow, especially when it comes to Tesla, relatively negative. But boy, we can buy these red candles over at Tesla because when we looked at those earnings, they're as rock solid as they get. Hopefully you guys have a wonderful weekend. As you can tell, it's smoking hot out here in California, and I've got a big old bright studio light on me, so I am sweating. I'm going to go take a shower. I hope you guys have a wonderful weekend. We'll see you again soon. Good luck with your investments.